Family offices manage over $8 trillion in private wealth across the Middle East, Africa, and South Asia. And in 2026, most of them are quietly doing the opposite of what their own assets allocation reports say they should be doing. On paper, the real estate allocation is going down. In practice, direct ownership of trophy lands, hotels, and building is going up. I want to show you why with the actual transaction numbers, not opinions. If you are new to this term, a family office is private entity a wealthy family sets up to manage everything. Investment, succession, tax constructions, and sometimes even the household staff. It's not a bank, it's not a fund, it's a dedicated team that works for one family's capital. The DIFC, Dubai International Financial Free Zone, now hosts more than 1,250 family related entities across the whole of UAE. There are 73 documented single family offices as of mid 2026, 50 of them right here in Dubai. There is not just one kind. Broadly, you are dealing with two very different groups. The first, the single family offices that we call SFOs, one family, one balance sheet, one investment committee. In this region, you have two flavor of these, the Emirati merchant families and the funding trading families of the UAE. And then you have the international relocated offices, the European, Indian, Russian, and the Asian families who have moved their structure into DIFC or ADGM, specifically because of the tax treatment, the residency program, and the time zone that bridge Asia and European market hours. Second, multifamily offices that we call MFOs. These serve several unrelated wealthy families under one roof, sharing the infrastructure, research, and the deal flow. Globally, MFOs now manage our $5.2 trillion combined, and 59% of them hold real estate directly on their books. The average single family office today run close to $900 million in assets under the management. That's the size of capital we are talking about walking into this market. Here is what matters for you as an investor talking to them. The family offices don't move like retail buyer. There's an investment committee, sometime a family council, real due diligence, and critically, most of them prefer control positions. Direct ownership, not fund units. And this is the detail almost nobody outside these words understand. JP Morgan's 2026 The Global Family Office Report find that the family offices targeting returns above 11% allocate over 40% of their portfolio to alternatives, and they hold almost double of the exposure to direct on balance sheet control investment compared to the average family office. Translation: the more ambition the family office, the more they want to own the asset outright, not sit in someone else's fund. So why Dubai specifically? Four structural reasons and one urgent one: the structural zero personal income tax, dedicated DIFC and ADGM family offices regime, purpose-built legal framework, not a workaround, long-term residency visas tied to the investment, and a time zone that lets one office run calls with Zurich in the morning and Singapore in the evening from the same desk. Our 55,000 high net worth individual already call Dubai home. Then the urgent. The capital is actively leaving other jurisdiction right now. The UK's non-dom tax status change are projected to push around 16,500 millionaire out of the UK in 2025 alone, one of the largest wealth outflow in decades. A meaningful share of that capital is landing here in DIFC and ADGM structure, looking for exactly what I'm about to show you. Now here's where I want to correct something. UBS 2020 Global Family Office Report, 307 offices surveyed, average annual $2.7 billion shows family offices planning to cut real estate allocation. from 11% down to 8% this year. If you stopped reading there, you would think real estate is falling out of favor. That's a wrong calculation. What actually shrinking is exposure through funds and REITs, the passive indirect route. What's growing is direct ownership of specific control position assets. And right now in Dubai, some of the best entry points are not showing up because the market is weak. They are showing up because the individual owner need to exit, a mortgage taken at peak, pricing a relocation, a business restructuring, a liquidity event unrelated to the assets itself. In Dubai Marina and Palm Jumeirah specifically, there is currently producing a verified discount of 10 to 15% below the market value from the motivated seller, not a distressed market. Distress timeline on specific owners. The same logic apply to the whole building. Older commercial and residential block depreciate in the hands of owner who can't or won't reposition them while the land and location underneath keep appreciating. The gap is where the return sits. I'm not going to tell you that Dubai real estate is booming and leave it there. I'm going to show you the transaction record. First, Scale Dubai Land Department data shows 419.94 billion dirham in real estate transaction in the first half of 2026 alone. 112,850 transaction with the straight property sale worth $286.43 billion across roughly 86,000 deal. That's the second strongest first half in Dubai history. Now, land in April 2026, DLD record shows a single commercial plot on Palm Jumeirah inside the Royal Amwaj development sold over 1 billion dirham. That's 858,645 square feet at 1.166 per square feet. One land transaction, 9 figure, fully on the public DLD record. Now the hospitality, and this is one I want you to pay attention because you almost never get to see same asset trade twice. The Shangri-La Hotel on Sheikh Zayed Road, 302 rooms, sold in January 2020 for the 700.2 million. The same hotel sold again in June 2026 this year for 1.1 billion dirham, roughly $911,000 per key. To AHS Properties, the same building, 6.5 years apart. That's the kind of appreciation on the single hospitality asset you can actually verify, not the estimate. And at the very top of the market, liquidity is not a problem. Either in June 2026 alone, unit at Bugatti Residence by Benghazi sold for 200 million and two Royal Atlantic Residence sold for 65 million and 63.5 million. Family offices sometimes assume ultra prime Dubai stock is liquidate. The transaction record says the otherwise. This is one video. What I actually do is sit across the table from families like yours and rank the option: land, ready luxury property, hotels asset, the whole building, a structured funding against the equity or collateral. Side by side, by yield, by liquidity, by appreciation potential, backed by exactly this kind of DLD and DXP interact data. Not one opinion, a comparison. If you want that comparison built for your own mandate, comment family offices below or send me a direct message and I will send you the full assets class breakdown directly. In the next video, I'm going to deeper into the land versus hotel versus building. The same format, same rule, every number sourced, nothing estimated.